Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Here we are for another episode of Black and White Market Chatter right here on Life Planning 101. Matt, Ervin, and Aaron Kennedy here with you for a little bit longer episode today than our normal, just a few minutes. So you have to hang with us through all the detail. We want to do a quick recap of what the heck we've been talking about, go through some of our themes and kind of how they're coming to fruition. So Aaron, talk to us a little bit about what's been going on.
Man, it's been busy. You know, usually when we do our Friday calls, we go through a bunch of stuff and we go so fast. I wanted to give a little bit of clarification of what we're talking about. I think big story is inflation. It's been inflation. We can all feel that, but that's not what's changing the world. Everybody has higher prices. What I want to look at is what's happening to the U.S. dollar. Why is the U.S. dollar so strong, and why is it even important? Who cares? We're kind of isolated here in the U.S. because it doesn't affect us, you know, but the rest of the world, it's a big deal. It's a really, really big deal. You know, depending on what currency that you're domiciled in, whether you're in Japan with the yen or Europe with the euro, every time our dollar gets higher, then the goods that you're buying from us is getting more expensive. And it's hurting you from an inflation standpoint. You know, on the flip side, our strong U.S. dollar has really benefited us from an inflation rate, and it's made it not as painful for us. So I know that's, what in the world does that mean?
Right.
But it could have been a lot worse if we'd have had a falling U.S. dollar. But around the world, this is a big deal, and different countries are really struggling with it. And they're asking the question of what in the world are we doing, and when are we going to stop? You know, there's some big problems out there. First is Japan. They're implementing yield curve control. So, you know, the big institutions are shorting Japanese bonds. So, shorting Japanese bonds, yield should be going up for those bonds. If I'm putting a whole lot of money betting that a bond will go down in value, that means yields are going up, right? So, if I have a bond that's paying me, if I have a $100 bond that's paying me $1, that's yielding 1%. But now if I can buy the bond at $50, that yield goes way up if I'm still getting the same dollar. Right. So what is Japan doing? These institutions are shorting bonds in the middle of the night, and then Japan is turning around and buying them back just as fast as they can because they want to keep that thing pegged to about 0.25%.
So what's that doing for them?
It's hurting their currency immensely, and they don't really care. They're wanting to keep interest rates at a certain point, and they're going to do anything to do it. And they are spending the yen like a bunch of drunken sailors, trying to keep this thing under control. And it will bankrupt the country if they keep this up. So they are really drowning right here and saying, U.S. Fed, what in the world are you doing? Stop.
So they're doing that in response to us.
Yes, absolutely. So that is a huge systemic risk. It'll expand around the world if it does finally break. So that's a big risk we're looking at. Europe, oh gosh, they can't keep themselves out of trouble. There's a war over there. Okay, that's causing a lot of problems. It looks like the Europeans are going to have a very, very hard time keeping their houses warm in the wintertime. As of right now, it looks like Russia is going to keep the Nord Stream pipeline open about 20%. They just signed this huge deal, you know, welcoming Russia into their country, telling them that they were going to supply all the natural gas. And wow, how'd that work out for them?
Yeah, 20%.
Yeah, they went to war. Russia really doesn't like Europe standing up to them, so they're cut off all the heat to their homes. You know, so that's not going to be good for the euro. And even right now, you know, the euro is trading on par with the U.S. dollar. So it's 1-to-1. Very, very close. And we haven't seen this out of that price. So the dollar's getting a lot stronger there. And where can Europe go to get natural gas? They have to come to us. Well, that natural gas, my gosh, that's trading at $8.3 right now. And then you slap on shipping, then you slap on an extra 15% of how much our dollar's appreciated according to them.
Gets expensive quickly.
It gets expensive quickly. And on top of that, there's a lot of countries over there that are going green very quickly. And, they're cutting off fertilizer and they're really pushing them to take on this new green ideas. So we're seeing a lot of people fighting back, especially the farmers. And we're realizing this now, but a lot of our food, even here in the U.S., is coming from overseas. Great deal of it. And they're trying to destroy supply over in Europe. And it's cutting into a lot of families' income. We see a lot of economic weakness there. Go look at what happened to Sri Lanka. They tried to do the same thing. They wanted to get really cute and go green and take away all the plant food. I think that president has been run off into exile and he's completely hiding in a different country. There's a new president and constant protests in the street. I think I was just reading that the new president they put in is trying to outlaw protests. Oh gosh, go look. There's pictures of protesters in the president's mansion swimming in the pool and everything else. I don't know how that's going to work out. Someone steps in, tries to go through the same thing, and the only new rule is no protest. Yeah.
Sounds like I got a heap of trouble over there. But let's take a quick break here on Black and White Market Chatter on Life Planning 101. We're back with section 2 of Black and White Market Chatter on Life Planning 101. We were just talking about Sri Lanka and how their Going Green movement wasn't so green for them.
Yes. The biggest story is if we look out across the world, everybody's struggling. Most countries are really, really struggling. And, if we look at how many years ago was it that we were talking about globalization and how this all needed to end and we needed to onshore more industries. This isn't about how much has been onshored and not. What I want everybody to realize is we are a global world right now, and you can't take the biggest countries on our planet and put them in such economic turmoil and not think that it's going to affect everybody. And it is, and we're seeing that right now. And a big part of it is the price of the U.S. dollar. On a good note, I think the ECB, or the European Central Bank, is raising interest rates for the first time in a long time. They're going to increase it up 0.5%. So they're not going to be negative across the board anymore. That will help with Europe, absent the Nord Stream pipeline, agricultural problems, just apples to apples. From an interest rate standpoint, that will help, but they got other things to fix. But it's a step in the right direction. Looking out, tomorrow is going to be a big day for us. The Fed's going to come out and talk, and all expectations are they're going to raise interest rates by 0.75% again. Now, 0.75%, the market is loving that right now. The market's up, 2.55% this month. So it's been a great month. It's been a very risk-on month. S&P's up 2.5%. NASDAQ's up 4.4%. Small caps are 4.3% up. So it has been a risk-on trade so far this month. And why? That's the head-scratching part. We came out with some pretty horrendous inflation numbers this month. And there for a couple of days, we were expecting the Fed to increase interest rates by 1%. Well, economic data's come out so weak that now we're only expecting 0.75%, and the market is cheering and going crazy that, hey, we're getting closer to the end.
So just a glimmer of hope, and the market's trying to soak it in.
Glimmer of hope, and we're going to get to hear about it tomorrow. So I don't know what the market does. It really depends on whether they put a pause between a sentence or a comma, or, that it's very difficult to figure out what the Fed is doing or what they're thinking. We do know this: everything is slowing down. All the economic indicators are getting weak, and that's what the Fed is trying to do. They're trying to slow down this inflationary problem we have. We can't import semiconductors from overseas. So, if you're struggling to eat or even drive to work, you really don't care about a semiconductor. So who needs to buy one if I can't even feed my children? So that's the route we've taken. It's crazy. Doctor, I got a blister on my toe. Well, let's cut that thing off.
Yeah.
That's what we're doing.
Yeah.
Oh, my goodness. But, speaking of economics, most of our manufacturing indexes have come out, and not only did they disappoint, but they disappointed in a big, big way. Things are not looking positive.
But we knew this was coming, right? We've
Yes.
been talking for 2 months about how things are slowing down and employment's slowing down and companies are not going to hire near as quickly. And we looked a little silly there in the beginning because nothing supported that. But it was clear. It was a clear sight. So when we look forward to it, we try to be ahead of things just based on good old common sense.
Yes. Even yesterday, the biggest part, let me back up a little bit. The biggest part of our economy is the consumer. So the most frustrating or confusing thing about our economy so far is all these things were happening and our consumer remained strong. Or that's what we were being told. They were just taking it on the chin and continue on. It doesn't matter if I'm spending now 30% of my income on fuel. I'm just breaking into my savings, and I'm not going to slow down my spending. Shopify is now laying off 10% of their employees. Walmart came out with some really bad numbers yesterday. They did well from earnings, revenue, not well, but their future outlook was very, very poor. And even Walmart, it dropped 10% overnight. It's getting into the consumer as we speak, or it's showing up in the numbers. Employment, that's going to start to come up. We're finally going to get to see that in the numbers because we're seeing companies talk about it. We're seeing companies lay people off, So here's the biggest question is seeing believing, because companies are telling us that they're doing it, but we got to hear from Janet Yellen this week and says we're not in a recession, we're not going to go into a recession. Our fearless leader came out and said we're not in a recession, we're not going into a recession. So what does that mean? Do we change the definition of what a recession is? Or do they know something that the different companies in the economy don't know?
Yeah. Let's unpack that a little more. But before that, we're going to take a quick break. Our second and final break on Black and White Market Chatter on Life Planning 101. And we're back here for the final segment of our episode of Black and White Market Chatter, Life Planning 101. Let's unpack the rest of this. You said something interesting, is the government knows something that the companies don't know. So there's a little bit of contradicting information there.
Yes. So we got some huge employers out there that are laying people off or stopping hiring. Got some of the biggest consumer-driven companies out there, Amazon, Walmart, Shopify, they're all warning us what's going on. But we're being told by other people that are running our economy or our government that it's not happening. Which one ends up being right? That's going to be the biggest question out there. Because I don't want to be a cynic or anything, but really if you go look at the news or anything, a lot of the times it's not really reported as what we're seeing or what we're feeling. And depending on what your thoughts of why they're doing it, it does happen. So, and from a psychological standpoint, nobody wants to be the only person in this country that it's not confident about what's going on. Right. I don't want to be the only person in Eastland, Texas that is struggling with fuel costs and food costs. So if I'm told that, hey, this is normal, I'm probably going to start to believe it.
Right.
But look at what this government's done. They have lowered gasoline prices the most in history.
Oh, wow.
It's fantastic. And we're being told that. It's like gasoline has dropped 38% over the last couple of months, most in history. Yeah. Still $4.50 a gallon, but
Well, we don't look at it that way. That's not how we do it.
yeah,
So the point, you can't pick your data points, right? The
Yeah.
facts are the facts. You have to keep
Facts are the
everything in
facts.
context.
So, just looking at everything, this is really a supply problem that's going on. We can't get the goods that we need. It's really not a commodity problem other than oil, energy. Most commodities have been coming down. Steel's down 31% over the last year.
Mm-hmm.
Copper's down 26% over the last year. Lumber's down 4% over the last year. So the building blocks of our economy are going the opposite way. The one that has stayed stubbornly high is energy. Oil's still at $94 or $95, which is great. It's not. It was floating in the 115s, so it has come down. But it's still $95.
Still not.
Gasoline's still $4.50. It's not $5, thank God.
Right.
But it is stubbornly expensive, and natural gas is high. And that natural gas, that's what heats and cools our home. So it's going to take more than the Fed raising interest rates to get this inflation problem under control. And it's going to take more than sending our country into a recession to slow things down, price-wise. They can slow down our economy. They can slow down our ability to buy goods, but they really can't slow down prices. And that's really where they need to go. And tomorrow, even if they say everything's working fine, we're going to stop this for a while. Market's going to cheer. Market's going to go up. It's going to explode up. And it's going to be fantastic. But what happens the month after that? We got August, and then the Fed, this is what they've been telling us, is that they're going to start quantitative tightening at about $95 billion a month, which they're going to be sucking out $95 billion a month out of our economy. That's going to slow down the economy too. They're going to try to get $1 trillion.
Has the same effect, right?
It's going to have the same effect. So I think the Fed is really embarrassed. I think the Fed and our government as a whole wants to look like they're in control. And we've talked a lot about that before. But economics, inflation, all of that stuff is backwards looking. And the problem, and the reason we say the Fed has gone too far one way or the other 100% of the time is it's because they're always looking in the rearview mirror of what's happened. And cause and effect, they go too far. And that's what they're going to do this time as well.
I'm glad you brought this. So that's the camp we're in. It's going to go too far again. So what are we doing to stay positioned for that? We talked a lot about that. We're really hoping for the Band-Aid effect, right? To rip it off and get after it and go again. But
yeah, that's really what we need. Second quarter needs to come out, and we need to be in a recession right now. That sounds horrible, but we need the numbers to come in very, very weak so the Fed starts to second guess themselves. If we're already in a recession, maybe the Fed starts to think, hey, we've done enough, we can do this soft landing, and now let the economy, this is just going to be a mild recession, resetting of prices, and they can take off. Go the opposite way and the economy can take off. That's the best case scenario. And that's what I'm hoping for, that we're already in a recession. I think we all feel it, we all see it, but we don't know. And we don't know how far the Fed is going to try to take this. They need to stop, though. They need to stop right now.
Yeah. And we're positioned for that, right? We talked, so we're positioned for a couple of different things.
Timing the market's a fool's errand. If you time it and you get it right, you probably only do it one time in an entire career. And we're not trying to guess what's going to happen. But we do have the portfolio set up. We have several scenarios that we should be really set up well. A lot of the companies that we're holding, or industries we're holding, are, let's just say, older industry, producer of things. A lot of it is dividend growth, so companies that have been very disciplined and higher quality over time, that know how to use their capital and can return that to shareholders in a meaningful way. We're all shareholders, so if they can give us money back, I'm happy with that. We're trying to put things in our favor. if you're invested with us and you have a 100% stock portfolio, guess what? I got over 20% sitting on the sidelines.
Right.
That's our aggressive portfolio.
Yeah.
You know, so even if we have something like that, we have dry powder ready to go.
But that's when those things, you always talk about in bad times, the correlation always reverts to 1.
Yeah.
So when things are that bad, there's no hiding. There's no safe
hiding.
corner. So that's what we're talking about. We can defend against different strategies, but the one where everything correlates to that
Yeah.
drawn out issue,
Yeah,
that's tough.
That's really where we're going to struggle. And another one that I'm a little fearful about is, you know, what if we have it like the COVID recovery? Like February, you know, we're scratching our head, oh my God, what's going on? March is like, oh, this is going to get bad. And then by the end of March, we're just right back to where we
We're
were.
rolling.
You know, a super, super fast recovery. We're not going to do as well there because, like I said, we do have 20% on the sideline. So we're going to be at least, if the market jumps up 10%, we're going to get 8 at best. Right. That would feel good, you know, and it would put some money into everybody's account, you know, but we're not going to perform because we're in protect mode.
Yeah. We're T-ball. We've been T-ball since day one. That's how we're going to continue to be. And that's why many investors are with us today.
Right. And if you go back 2008 to 2000 through 2002, you know, really your buys towards that bottom, that's going to set you up for a lifetime of returns. If we can get the buy right towards the bottom, you know, this is going to look really good, and our T-ball approach will have paid off, and you know, we're going to look just as good as people that took the highest risks out there, you know, and we did it being risk conscious the entire time.
Right. Aaron, I hate to cut you off, but we do got to get wrapped up for this third and final segment on this episode of Black and White Market Chatter on Life Planning 101. If you like what you hear, join us every Friday for our shorter episode, Black and White Market Minute. Same spot. But for today, Matt, Ervin, Aaron Kennedy signing off with you. Have a wonderful day.
Yeah, thank y'all.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Don't forget to learn how our sister company can assist you with all of your tax, bookkeeping, and consulting needs. You can find out more at briscoeandassociates.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.